Hey, what's going on, guys? Welcome back to another video. Today I'm going to show you guys how to trade like the banks, and to start off by it, you guys need to understand the first three things. Number one, banks like to accumulate orders. Number two, they like to manipulate market. And then number three, distribute their orders. So, what is this going to look like? This will look like an accumulation area where we start to consolidate. Everyone knows what consolidation looks like. If you've watched the past videos, it just means that we're staying within a zone and we're kind of just ranging between it. Then what do? We manipulate market. We manipulate market by pushing up a certain direction, making everybody believe, hey guys, we're entering our calls now, start pumping in your money, and then afterwards they're going to displace. You guys are going to think that, hey, hold on, we're still holding our structure. From there, a fair value gap gets formed here, and that is exactly how market manipulates people into thinking we're going to go up, and from there, that's when you create that crash. So let's go find how they do this. So they accumulate orders, manipulate market, and then distribute it. Let's see how we can go find that in actual market sessions. Remember, banks trade in a lot of liquidity. They sometimes can't fill in automatically, so what do? They start accumulating positions. That's when we start getting that accumulation where we just start holding orders. Okay, perfect. What do we start doing after that that we know market likes to do? We like to manipulate the market. Now, a lot of people aren't going to see this as manipulation, but I will, because we are entering what we've also talked about is our liquidity zones. Banks like to target liquidity zones because that is where it's cheapest for them to buy. And if we graph our equilibrium, we can see that we've headed straight into a discount price within the accumulation manipulation phase. Now we're going to get that perfect entry to be able to enter for puts and crash it all the way down. Here, look, you just made a super simple 4.7 risk reward ratio just simply following accumulation, manipulation, and distribution. Okay, perfect. Now we know that it works. How can we always spot it? Number one, you're always going to want to make sure that when we're accumulating, we are genuinely going towards something that's going to allow us to pull back. So when we're accumulating orders must be heading into discount price, meaning that our accumulation of orders is slowly heading up to the 0.5 level. Okay, perfect. What's after? When we start manipulating, we need to make sure that we manipulate in the direction of where our discount price is. After we've manipulated to over there, which was this, we've manipulated up. After that, we need to make sure that where we expect to displace has a liquidity zone to it, meaning that there is an actual point of liquidity that we can backtrace it to that's going to give us that confirmation, hey, we are most likely looking for puts. And what is that overall hourly daily bias? Lower lows, lower lows. What did we do here? We finally swept by sell-side liquidity, we created structure up, but we wanted to continue the overall trend. So what was going to be the best way to do it? To come back up into a discount price zone and dump the market. That is how you trade like the banks. Banks like to do this because they like to manipulate price after they grab liquidity. So, as everyone is expecting that, hey guys, once we get past this high, we're going to want to look for our call entry because they're expecting for the trend to continue. What banks like to do is then manipulate markets here. What are they doing? They're accumulating their orders. They're now manipulating the market. And what do they eventually end up doing? They end up bringing price down into a point that people think, okay, perfect, we're most likely just retracing to go back up. But in reality, this is where banks are entering their positions. And you could see here by this liquidity zone that we created and that we're breaking the 200-day EMA. We're getting lower than it, showing that we have more bearish power. Then we come back up to reject it and dump the markets. Remember, When you have those stop losses set up right on top of that buy side liquidity, just remember that's what the banks are looking for. They're looking for your stop loss right above that buy side liquidity, so once they sweep it, they can then dump the market. How many times can you say, damn, market just hit my stop loss and then it dumped in my direction? It's because the banks are manipulating it. I know it can sound very complicated, but I want everyone to know that's watching this that you can come to me in my Discord server, ask me any question, and I will go to you, and hopefully we can hop in a call and we'll go over it together. I want everyone to learn this. I want everyone to understand that this is what the banks are actually doing. The banks like to target liquidity, they like to manipulate market. They like to use institutional tools and strategies like order flow, dark pools, sophisticated algorithms that I obviously teach within a higher method, but this is just the plain version of what they look for. They're going to look for order blocks, they're going to look for liquidity zones, they're going to look for fair value gaps, and that is how you can always know what they're trying to do. Just as long as in the back of your mind, you're remembering that we are accumulating, manipulating, and then most likely distributing. Everyone have a great day, and I'll see you in there.